Hello, everybody. Mike Sorrentino here, and thank you for taking the time to listen in on today's market pulse. We got Bepin with us, and it's been a while since we talked, and I wish I could say that we were out taking a vacation, but I'll be honest with you, Bepin. I think one of the reasons why I didn't want to talk was because I'm tired of the tariff stuff. I'm sick and
It
tired of
was
it. Like
hard coming
I
up
don't
with a
want.
title that didn't include tariffs. We went
Oh,
through
it's
like
brutal.
15 different ones before we settled on 100 days in.
How? I mean, I would love to see one of those. When they sometimes they'll scan newspapers and they'll try to count certain words to see like what words are like really in the headlines of newspapers.
Hmm.
I cannot imagine the delta between tariff has to be number
Tariffs and the
one,
next thing. Yeah.
and
Well,
the
tariffs
next
and
thing,
Trump, but it's going to be
yeah,
one of those two.
it's been crazy, and with all the tariff talk, what we've tried to do today is we're not going to ignore tariffs. Unfortunately, I'd love to, but we're not going to.
Yeah.
What we're trying to do is kind of go underneath those headlines a little bit to look for some of the data and some of the trends that I think uh, are not getting enough attention, or for that matter, might be kind of directing our investment strategy as we go forward. So,
Mhm.
with that, let's go ahead and talk about the first 100 days of the Trump administration.
Well, let's
Now,
start
before
with
that,
the great Warren Buffett first.
yeah, exactly. We talk about the 100 days, but ultimately, I'll be honest with you, I was a little surprised that this didn't get more publicity. It got obviously it was in the top of the Wall Street Journal, things of that nature. But Warren Buffett this weekend announced he was going to step down as CEO of Berkshire Hathaway. Now, Warren Buffett is, I think there's no question, he's probably the most famous investor in our lifetimes,
Hmm.
and it's going to be difficult to find somebody to kind of take his shoes going forward. But uh, he he is always had a very long term view. I think one of his greatest quotes, which we're not using here, was, the most ideal holding period is like never sell,
Yeah,
basically, right? Which is
exactly.
unrealistic, I think, for most of us. But
Hmm.
that was his strategy. But I think another key point about him, and again, things that go unnoticed, was he was such a bull on the
Hmm.
American economy and the American way of life. And it's not just drinking Coca-Cola and going to Dairy Queen and all those things that he does. He truly believes that the capitalistic society that we live in is one of the best places to invest. Hence this quote here. It's never paid to bet against America. We come through things, but it's not always a smooth ride. I mean, man, that is emblematic of 2025, in my opinion. It's not been a smooth
Exactly.
ride, but again, you know, push the tariff stuff to the side and think about what we're dealing with. We talked about this golden era so many times now. Nothing's changed, Beth. And like I don't
Hmm.
think anything's changed. All those opportunities we discussed for well over a year now, or 2 years now, whatever it's been, to
Hmm.
me, it's just getting better and better and more exciting. But that being said, we got to give credit where credit is due. Warren Buffett has absolutely crushed crushed the S&P 500 in his time at the helm of Berkshire Hathaway. All right, here's a fun fact that we found recently. Warren Buffett could take a 99% loss tomorrow, okay? Literally, Berkshire going down 99%, and he would still be beating the market.
And you
These numbers are absolutely staggering.
And you can fact check that if you're sitting there at home and don't believe it, because Mike sent this to me earlier this morning, and I didn't believe it either. So I brought out my hand math calculator, and 99% loss would bring them down to being up 55,000%, beating the S&P 500 by 16,000% after taking a catastrophic loss. It's insanity.
It's I cannot explain how hard it is to outperform the S&P 500 by 2% a year
Yeah.
consistently. 2% is a very difficult thing. 3%, now you're talking about genius level. I mean, he's basically doubled the S&P now for what, 40, 50 years? I don't even know what the
Mhm.
number is anymore. It's just staggering. So, credit where credit's due, and it's a testament to Buffett's style of investing. Ignore the noise, ignore the volatility, focus on the fundamentals. All right, let's get into it.
We told you we'd
Uh,
be talking about tariffs.
Yeah, we had to do it, right? I
Yep.
mean, look, it's and Bethany brought up a good point before we got started here, is that it's hard to find objective data. It's very hard to find objective data around Trump, his administration, and these tariffs, okay? Because it's either going to be highly supportive and biased, or it's going to be extremely negative and also biased, right? So what we try to do here is we try to focus on the data, the stuff that really can, I think, can kind of tell the story. And ultimately, if you look at the tariff revenue that's come in the first 100 days, it's high relative to other the start of administrations, right? So, I mean, ultimately, this is again, some people will look at this as being a great thing for the economy. Others say, well, the number's not high enough to really matter. Let's just push it all aside. The fact is that the tariff policy in place right now is generating a fair amount of income for the country. The question is, what's the trade-off? And that's something that's going to probably take a little bit of time to play out. I mean, Bepin, I'm still in the camp of that these tariffs are pure negotiation tactics, and the money the revenue that's being generated is nice, but ultimately, aside from China, I could see a lot of these tariffs probably dissipate over time. But it's a guess. I don't know.
We're all on that camp, because if they're not, then obviously there's likely going to be some pain from the tariffs. But I think they see that as well, and that's kind of the game they're playing out right now, is who folds first.
Yes, exactly. So, but it is something that we're going to probably not see leave the front page of the newspapers anytime soon. Another thing that has happened in the first 100 days, and I think in many ways we've discussed this to a degree already, is that the first, call it 90 or 100, 120 days of a new presidential administration tends to be very volatile, and the returns in the S&P tend to actually not be that great.
Right? Look at that jumble on your screen right there. There's lines going all over the place.
It's everywhere. It's completely everywhere. So if you average all that insanity together, you actually see a very flat line across most of these administrations. So again, I think that if you think about what's causing this volatility, every time what's interesting here, Bepin, is I think that we're seeing a very consistent trend relative to other administrations that are getting started, right? Where there is a lot of volatility and not a lot of returns, but the underlying drivers of all of these situations, I think, are often very different, which is where the irony comes in. And we've discussed this also a little bit, where we went for a year and a half with virtually no volatility. Okay, when you do that, volatility is a compressed spring. When you push it down, it gets stronger over time, and it gets more violent in terms of the reactions coming back. So I think in many ways the market was looking for a reason to sell. Okay, now what I mean by that is that people get a little anxious when you start making a lot of money. You know it's coming. You know the volatility is coming, and at some point when it does, people freak out and they panic. Add on top of that a tremendous amount of leverage in the system. Okay, a lot of margin debt, a lot of ancillary drivers to that volatility. And the reason why I can say that so confidently is because, yes, it's been volatile, but it's been extremely volatile with virtually no news cycle around the underlying economy. Now, I know a lot of people want to point to tariffs as being the case, but I just don't buy that. I don't buy that a $27 trillion economy is that sensitive to a little bit of tariff talk.
That's kind of how I explained it too, is that there were a lot of underlying things, like you said, the leverage, the all-time high valuations, gains for 2 years in a row, double-digit gains, 20% plus. But it's hard to deny that the inertia wasn't the tariffs, So it's not the whole cause of the 20%, or we got close to 20% drop, but it definitely started getting people to reconsider their position in the market.
Here's another trend that admittedly, this has gotten a little bit of headlines. The dollar is getting weaker and weaker. Beth and I took my daughters over to Rome, Italy for spring break this year. And when I booked the trip back in January, man, was I excited, because the dollar to euro it wasn't parity, but it was pretty close, meaning that $1 was very close to €1. So when I booked a trip, I'm like, this is going to be great. And get to go over to Europe, I'm going to be happy as hell because it's going to be cheaper. And then what happens, I get there in late March, and the dollar is like 10% weaker.
You didn't hedge out your currency risk, Mike?
I did not. I should have gone to the Forex market and done that. Had I known, I would have 100% done that. No, joking, everybody. Never trade currency under any circumstances. It's like the wild
Don't listen to any of those gurus online. They're all
do not trade currencies. It is one of the easiest ways to lose everything. But that being said, the dollar's weaker. The dollar's weaker, and Is that a good or bad thing? We have a natural reaction to the word weakness. Okay, weakness meaning that something's getting worse.
Mm-hmm.
But currencies aren't always what they seem to be. A lot of times, a weaker dollar is a very good thing. All right, for me, it was not a good thing, right? Because I got over to Europe and everything was, technically 10% cheaper based on where my mind was anchored when I booked the trip 3 months ago. So I was
Mm-hmm.
annoyed by that. Okay, but a lot of times it's very good for a country. So
Mm-hmm.
if we have a weaker currency, then our exports tend to be more attractive than other countries. So a lot of times you'll see countries like, especially China and other export-heavy countries, they'll do things to manipulate their currencies to make them actually weaker, so that way their exports look cheaper relative to other countries. Okay, so and there's been a lot of talk about Scott Bessent and Trump in terms of their administration and their goals, and the rhetoric out there, at least from what I've been reading, Bepin, is that Trump wants a weaker dollar.
Yeah, I think we even told the clients, I think 4 or 5 videos ago, that was going to be a goal of the administration. Like you were mentioning, it hurts imports in your case. When you do travel overseas, that's considered an import because we're importing those services that they give you there to an American. But when you're trying to boost manufacturing, a weak dollar actually helps quite a bit. That's kind of the goal. This is very consistent, I'd say, with if you are trying to boost manufacturing and you're doing it via tariffs, then you'd want to weaken dollar, and that's what you're getting.
So whether you like it or not, I think a lot of the Trump administration's near-term goals are playing out to a certain degree. Now, again, I'm not supporting them, saying they're good or bad in any way, shape, or form. I'm just saying that a lot of his stated agenda, let's put it that way, is in full force as we see today.
And kind of switching gears here, well, hopefully walking away from the politics and the tariff talk. Obviously, we'll have to mention some tariffs here because we're going to be looking at some data. So if you happen to listen or read the article from last week where we went over some charts that are driving the markets, this would be the hard data. So the U.S. consumers and businesses are still spending. The first chart you're looking at there is the retail sales. And if you look over to the right, we're at an all-time high. So as scary as the tariffs are and as scary as they could be to your business, companies are still spending, and so are consumers. And the next chart you're looking at here is the manufacturers' new orders for non-defense capital goods. Think machinery, things that you would need to expand production to expand your business, and that too is hovering around near all-time highs. These are all very bullish for the economy long term, as me and Mike have mentioned probably on numerous different episodes here. The largest drivers of GDP are consumer spending and business spending. And as of right now, they are still spending. Now, the argument can be made that, sure, some of these manufacturing orders that we saw in early 2025 were to get ahead of the tariffs a bit. If you're going to order that new machine, some of it's from China, why not get in front of it right now? So some of that may be part of these numbers being so high, but they weren't beforehand. If you look at this chart from the end of 2024, it was still at an all-time high. I think a lot of it is just a continuation. But yes, there is uncertainty with businesses, and we've been seeing it in the survey data, which brings us to our next slide here, which is optimism is falling. And it's not just businesses, it's consumers as well. The chart you're looking at here is the University of Michigan Consumer Sentiment Survey. As you can tell, that dotted black line is the current data, it's the monthly data, and then that blue line is a 3-month moving average. So just kind of showing you the trend on top of just the static data. And as you can tell, the trend is, as well as the data, it's all down for the most part, as people are starting to get concerned about how are these tariffs going to impact them? How are these tariffs going to impact businesses? Which brings us to the next one, which is optimism index for small businesses. That's also taken a nice dive, which is kind of interesting to see, because if you see that right before this little drop down, you see that huge spike up. You know what that coincided with, Mike?
Oh boy, let me guess. The election.
Exactly. Yep, exactly. So as the odds of a Trump presidency came in, everyone kind of looked back to the 2016, 2020 era and remembered that golden age of just prosperity across the market, low inflation. And assumed the deregulation and all that would continue again this cycle. So their optimism skyrocketed. So any reading above 100 here means that they're increased optimism, or optimism's at near high. Any reading below 100 means it's dropping. It's getting lower. People are becoming a little bit more worried, a little bit more pessimistic. The concern here is that this is soft data. So one thing to just keep in mind with soft data is when there is periods of uncertainty and when there is somewhat crises, in this case, this is just mostly uncertainty. I wouldn't say it's a crisis. The respondents to these surveys start like everybody else. Our human nature is to be worriers. That's how we've survived. That's how we've evolved as a species, is to be worried of danger. So when things arise, we overreact. We tend to overreact. And that's why the fear is that the survey data, so how people are feeling, will translate into what they are doing. But we have not seen that thus far. They are still spending. They're just not feeling good about the future. So it's a very weird time period right now. The next big elephant in the room would be the GDP print. So that first quarter GDP for 2025 came out, I want to say last week. And for the first time in 2 years, we saw a negative print. I believe, 2 years from the 2022 negative print. So that's when we actually,
correct.
if you recall that year, that was when we had that interesting change of classification, or at least we were all reminded of the second variable, which is that gross national income also has to be measured. So we had 2 negative GDP prints, but we had a positive gross national income. So it didn't count as a recession in 2022. But besides the point, this reading here from the first quarter of 2025, if you look all the way to the right, there was one big detractor, and it was imports. What you saw is a lot of companies and a lot of people ordering things from overseas to get ahead of these tariffs. And as you know, that imports are negatives to GDP. Exports add to GDP. When you import something, it's going to subtract from it. But that's been the main focus, right? But what I really want to focus on here is if you look over to the middle of the screen there, you'll see consumer spending and investment. Both of those were stellar readings. And like me and Mike were saying, that this is what drives the majority of GDP. What we had is a really kind of like a man-made shock almost, where we saw imports have to skyrocket over some potential policy changes that could be coming. I can't remember a period in time where you could see something similar to this, but usually the number one drivers of a negative GDP. Yeah, exactly. You're obviously a little bit more, you've been in the industry a little longer, so maybe you've seen some numbers, but I've never seen anything like this, where you see consumer spending, investments all up across the board, and investments in general are quite high. That reading of almost 4% is kind of insane. It's a very high reading. We rarely see a negative, like an economy contracting, when consumer spending and investment are holding up. But on this next chart here, what you'll see is that imports were the main cause of that. That was just primarily tariff front running. So the goal would be that if we can see, like me and Mike were talking about, that these are negotiation tactics, and we do start getting some certainty, and we do start getting some of these maybe deals, or maybe we just see tariffs start get lowered without really any deal signing. We can just always set the terms. This is what the new tariff rate is, and you can accept it or you can't. But if we start seeing those numbers start coming down, I think you'll start seeing the front running come to a stop, or at least slow down dramatically. And we could see a positive GDP print in the second quarter or in the third and so forth. But what I'm trying to get at here is this isn't like consumers and businesses shuttering down. This GDP print you saw was primarily a factor of how we calculate it. Imports are a negative to the economy, but they're not a negative, I'd say, to the long-term growth. A negative to long-term growth is consumers stop spending and businesses stop investing. If you see those instances, that's when you can see some more of those structural recessions that tend to be longer and a lot nastier for investors, similar to 2008. But we don't think that is the case here. We believe that tariffs are still negotiating tools. We do think we're going to start seeing some de-escalation here pretty soon. I think we're meeting with China this Saturday. So while you're listening to this, it'll be the next day. We could start getting some headlines of de-escalation. And I wouldn't be surprised if the deals, or at least frameworks of deals, start rolling in over the next few weeks here as we meet with numerous countries. And we could be past this by hopefully the 4th of July, right? Everybody wants to enjoy their summer, right? But we'll see how it goes. We obviously still want to stay invested. We still believe in the long-term growth of America. Similar to Warren Buffett, we're going to take a page out of his book, and we're not going to bet against America. But obviously, we're going to keep our eyes on the market and prepare for any eventuality that comes. So with that, we would like to thank you for tuning in. As always, if you have any questions or if you ever want to talk to your advisor, feel free to reach out to us at any time. Have a great day and enjoy your weekend. Thank you.